Hi, my name is Elliot Gu, co-founder and chief analyst for Scoop Premium. I'd like to thank you for signing up for our Scoop VIP program. Today, I want to tell you about one of my favorite stock market sectors to buy right now. It's a group I've been covering and recommending for a while now in our deep dive investing service. And today, in this video, I'm going to tell you about one specific stock I'm recommending right now, plus one popular and very widely recommended name I believe to be a dangerous stock you should avoid. However, before I get into the specifics, let me back up and tell you a little story about something called the Rule of 3-6-3. I actually first heard about this rule a long time ago when I was home from college and had a summer job at a local bank. In between fetching cups of coffee and making copies and filing documents, I was even sending faxes back there if you remember those. In between all those summer job type tasks, one of the bank's vice presidents told me about the 3-6-3 rule of banking, and it went something like this. Banks are in the business of taking in deposits on which they pay 3% in interest. Banks then lend that money back out to consumers and businesses at a 6% rate of interest. And if you do that right, you can probably hit the golf course in time for that 3 o'clock tee time. So 3-6-3. Now, of course, this rule is a little bit tongue-in-cheek, maybe a little bit anachronistic, right? I mean, after all, I don't know about you, but it's been a long time since I've received anything close to a 3% rate on bank deposits. But the truth is, the basics of this business are still the same. Banks make money by taking in deposits on which they pay a low rate of interest, and then they turn around and lend that money back out for a higher rate of interest. The difference between the rate they pay on deposits and the rate they receive on loans is called the net interest margin. And it is a key fundamental, arguably the most important fundamental, to watch, especially for the regional banks, which do a lot of lending. As you might have guessed, the regional banks are one of my favorite groups to buy right now, so let me explain that. So you probably heard that old rule of thumb, often in the financial media. It said you buy financial stocks when the Fed is hiking interest rates or when bond yields rise. You probably heard that. Now, the rationale for that is that when interest rates are on the rise, banks can charge higher rates on the loans they make, and therefore their net interest margins rise, and they make, quite simply, more money. However, like so many of these simplistic rules like that, there's a kernel of truth there, but also some major caveats you must keep in mind if you want to make money in this or any other sector. The first thing to keep in mind is you don't want to forget the first part of a good old 3-6-3 rule. In other words, the first rule of banking is to take in deposits on which you pay a relatively low rate of interest. So if a bank is truly going to benefit from rising interest rates, then the rates they pay to depositors must rise at a slower pace than the rates they charge on loans. We call this the deposit beta. In other words, if interest rates go up by, let's say, 100 basis points, which is 1%, and then the rate that the bank pays to depositors only goes up by 20 basis points, or 0.2%, then the bank has a deposit beta of 20%. So overall, the lower your deposit beta, the better it is, the better the bank. Of course, there are a number of factors that influence deposit beta, including regional competition for deposits, and of course, a bank's loan-to-deposit ratio. And I'm going to talk about that a little bit more here in just a minute. I don't have time in this short video, of course, to go through all the nuances, but let me say this, get 2 quick points to keep in mind. First of all, some states and regions of the country, such as New York State, have more competitions for deposits right now than others, like, for example, Texas or parts of the upper Midwest. That means that banks in these areas generally have to ramp up the interest rates they pay depositors at a faster rate than other banks, because they need to compete for depositors and they need to pay higher rates to attract depositors. And or they have to offer a higher mix of products like CDs, certificates of deposits, or savings accounts, money market accounts that pay higher rates of interest than, say, a typical interest-free or low-interest checking account. I also like the second point to keep in mind is I also like to take a look at a bank's loan-to-deposit ratio. In other words, the total value of all loans outstanding divided by the total deposits that are on the bank's books. The average for U.S. regional banks in the KBW banking index right now is a little bit under 90% loan-to-deposit ratio. Now, banks with a higher loan-to-deposit ratio would need to attract new deposits, probably by offering high-yield savings products or CDs, in order to support any loan growth. Okay, on the flip side of the coin, you also want to take a look at a bank's loan book. We just talked about deposits. Now let's look at the loan book. If a bank has a lot of fixed rate loan products like multifamily loans and residential mortgages, they're not going to see much benefit when interest rates rise. That's because these are fixed rate loans. So the rates banks charge on these loans doesn't change. It's locked in for the term of the loan. Now when rates are rising like they are right now, what you want to look for is banks with a large book of what are called commercial and industrial loans. Sometimes you'll see it as C&I loans. These are basically loans to businesses, and they typically carry, and this is crucial, floating rates of interest. And those floating rates are typically indexed to a benchmark like the 3-month Treasury bill, the 30 or 60-day London Interbank Offered Rate, or LIBOR. So let's look at those typical C&I loan benchmark rates so you can see what I'm talking about. This first chart here on your screen is the 3-month U.S. Treasury yield going back over the last year. So you can see that around a year ago, these T-bills yielded around 72 basis points, which again is 0.72%, compared to about 167 basis points or 1.67% today. So in other words, the yield has jumped almost 1% or 100 basis points in just the last 12 months alone on that 3-month T-bill. So let's say a business takes out a loan from a bank to buy equipment for a factory floor, for example, and that loan might carry a floating interest rate of, say, 5% over the 3-month T-bill. So over the past year, the rate the bank charges on that loan has risen from 5.72% to 6.67% automatically. That's a big benefit. That's a big jump, and it's going to tend to drive up the net interest margins for banks with a lot of C&I loans. And here's also a chart of the 30-day LIBOR, London Interbank Offered Rate. As you can see, these yields are up roughly 85 basis points, so 0.85% over the past year alone. So banks with a lot of C&I loans leveraged to LIBOR have also benefited a lot over the past year. Okay, so here's the part you've probably been waiting for, not the theory, but the practice, right? Let's get into the regional bank I like here and the name of one I want you to avoid. So let's start with the one I want to avoid. The reason I'm bringing this up is that I'm asked about this name a lot. The company's called New York Community Bancorp. The symbol there is NYCB. I think I get asked about it a lot because it's got a big dividend yield. It's around 4.7% right now, and it's one of the highest in the entire regional bank universe. However, I still think it's really a name you want to avoid despite that attractive yield. New York Community Bancorp currently has a loan-to-deposit ratio of 132%. Remember I said the average is a little under 90%? This is actually one of the highest, and actually it is the highest in the entire regional banking coverage universe we have, which is 74 banks. So this means they're going to need to attract more deposits if they want to grow their loan book. So, and of course this is just anecdotal, but I went on their website the other day, and I see that they're actually advertising a 1.9% annual yield on the 12-month CD and 2.1% on 24-month CDs. And CDs are a pretty expensive type of deposit for banks to have to attract. And you can see this in their numbers as well. So just look at their most recent quarterly release and their mix of deposits. And they only have about $2.78 billion in non-interest-bearing deposits. So these would be mainly business and personal checking accounts. They only have $2.78 billion worth of those out of a total of some $26+ billion in interest-bearing deposits. So they only a small fraction of their deposit book is non-interest bearing. And those are the best deposits for a bank to have because the rates that they have to pay depositors doesn't go up at all when rates rise because they don't pay interest. If we look at their interest-bearing deposits, I can see on their latest account for the fourth quarter, savings accounts currently on their books have a pretty low yield of around 0.55% on average last year. And that's only up about 1 basis point or 0.01% compared to 2016. That's not that bad. However, the thing to look at is they're actually losing deposits in this category. In fact, the only deposit category to see growth for New York Community last year was CDs, where the average yields jumped 14 basis points to 1.25%. And honestly, it gets even worse than that. New York Community Bancorp actually borrows a lot of money, some $12.8 billion last year. they're borrowing money because their loan to deposit ratio, again, their loans are larger than their total outstanding loans are larger than their outstanding deposits, and they're borrowing some money to make up that gap. Now the yields they pay on the borrowed funds is sky high. It's 1.73% annualized on average last year, and that's up 19 basis points to what they paid to borrow money in 2016. So the thing is that with interest rates rising, New York Community Bank Corp is actually getting squeezed on the deposit side because as interest rates rise, they're having to offer really juicy yields on CDs and other high yield savings products to attract depositors. And they really need deposits because they have such a high loan to deposit ratio. Now let's look over on the loan side of the equation. Most of New York Community Bank Corp's loans are multifamily mortgages. So these are mainly on apartment buildings located in New York City. Now, close to 90% of the buildings that secure these loans are rent-controlled apartments or rent-stabilized apartments. So here's how multifamily loans work. Typically, in New York Community Bank Corp's case, they have a total loan term of between 10 and 12 years. And they carry a fixed interest rate for the first 5 to 7 years of that term. So they don't enjoy much benefit at all from rising rates because their main loan category is basically a fixed interest rate loan for the first 5 to 7 years of the loan. So in order to benefit from rising rates, they have to issue more loans. And that's not happening right now. I would say that New York Community, it's not a bad company, and it does have a few points in its favor. For one thing, I believe that the tax cuts actually saved them. Saved their dividend from getting cut this year. Their dividend coverage is very low. They pay a relatively high effective tax rate. So the tax cuts that were enacted at the end of last year are actually helping them a lot in terms of maintaining their dividend. I don't think their dividend is going to get cut, but I don't think there's any growth there either. Also, the New York multifamily lending business has historically been a defensive market during economic downturns and recessions, right? Because rent-controlled buildings tend to have low vacancy rates. After all, if you have a below-market rent on an apartment, you have no reason to want to leave that apartment and move somewhere else. You're going to try to keep that rent-controlled apartment for as long as you possibly can. Now, all that said, New York Community Bank Corp is a bank that's actually getting squeezed by higher interest rates. Their net interest margin was actually 2.85% in 2016, falling to just 2.47% last year, despite the big rise in interest rates I showed you on those charts earlier. So bottom line, sell New York Community Bank Corp, symbol NYCB. Okay, so you're probably wondering now, how about a bank to buy? Okay, I think Comerica, trading under the symbol CMA, is a good bank to buy if you're looking for leverage to higher interest rates, and here's why. Comerica is based in Dallas, and it has large loan and deposit books in Texas, California, and Michigan. The bank, though, is one of the few business banks of any size still around in the United States. Commercial and industrial loans account for about 54% of Comerica's loan book. So as I explained a little while ago, these loans are generally indexed to short-term interest rate benchmarks like LIBOR or that 3-month T-bill, so they benefit directly from rising rates, and they're floating rate loans. In fact, only around 10% of Comerica's entire loan book is fixed rate. About 60% of their loan book is indexed to 30-day LIBOR, and 15% is indexed to 60-day LIBOR. So mainly floating rate loans there. Now let's flip over to the deposit side, and I'm looking at their most recent quarter here. They have about $32.1 billion worth of non-interest bearing deposits. So these are mainly checking accounts that don't pay any interest, commercial and retail checking accounts. And that's nearly half their total deposit book. All told, in 2017, Comerica charged an average rate of 3.86% on its loans, up 52 basis points from 2016. And on the deposit side, thanks to that huge they have that huge non-interest bearing deposit book, but also even on their interest bearing deposits, they only paid an average of 0.19% in Q4 across all their interest bearing deposits. A tiny rate of interest, only up 5 basis points from 0.14% in the fourth quarter. That's fourth quarter of 2017 versus 2016. So that's a huge benefit for them, that their deposit beta is very low, yet the yields they receive on loans are floating higher with interest rates. So overall, the net interest margin jumped from 2.71% in 2016 to 3.12% last year. That's one of the largest increases of any bank in our coverage universe. So in summary, I think you should sell New York Community Bancorp, symbol NYCB, and buy Comerica, symbol CMA. And this is probably the most important point of all, keep watching your inbox over the next few days because I'll be sending you another video like this later on this week that I promise you won't want to miss. I'll actually be telling you about an area of big risk I see for the U.S. stock market. I don't think it's getting enough attention in the financial media right now, and my research suggests that some popular stocks could get hit very, very hard when this trend plays out over the next 6 to 12 months, maybe even a little sooner. So thanks again for listening, and keep watching your inbox.